Do you know the 8 biggest myths about investing? The stock market can be an incredible tool for increasing wealth, especially over long periods of time. But making sound investing decisions is largely dependent on possessing an accurate set of beliefs. This video will examine the top 8 myths of investing. Are any of these myths hindering your investment results? First myth: larger cap stocks are better than small cap. Most media focuses on large stocks like Apple and Tesla. This is done to make the information more relatable to the average investor. We've all heard of Microsoft, the most famous investor in the world, also focuses on large stocks. But this is out of necessity. They have so much money that they have little choice. Warren Buffett has hundreds of billions of dollars to invest. A small cap stock simply won't work for him. Next myth: the best time to purchase a stock is after a dramatic drop in price. When a stock has lost considerable value, it may or may not be a good time to buy. The fact that a stock price has fallen is not necessarily an indicator that the stock can't fall further. Remember that the lowest a stock can go is 0. Also think about, why did the stock drop? Is your expectation that the stock will rise justifiable? Have a good reason behind your decision. Similarly, a rising stock isn't necessarily a good purchase either. If the stock price is rising for a good reason, that indicates healthy long-term profit. Should you expect the stock to continue to rise? Things to consider. Next myth: a little knowledge is enough to do well in the stock market. In most things, a little knowledge beats none at all. However, in the stock market, this can be a dangerous attitude. A little knowledge can result in overconfidence, and overconfidence leads to poor decision making. The best amateur investors have a high level of knowledge and understanding. It's not necessary to understand every type of company, but the average person can become an expert on a particular industry. Do your homework, and you're likely to be well rewarded. Next myth: to be successful, you have to take your profits. Many investors insist on selling and taking profits when a certain profit is attained. There are 2 issues with this strategy. 1, there really isn't a limit on how high a stock can go. To take a 20% profit and run eliminates the possibility of making 100 or 1,000% profit or even more. 2, taxes inhibit future gains. When a profit is taken, the government wants its cut. That means less money to invest in the future versus keeping that money in the same investment. There are advantages to holding a stock. Next myth: high diversification is important. Many famous investors have made comments that diversification is great if you don't know what you're doing. Diversification is a useful tool for minimizing losses. When certain stocks fall, others tend to rise. This is great when one of your stocks tanks. Unfortunately, it works both ways. When certain stocks rise, others tend to fall, so profits are limited in the same way losses are limited. World-class investors have suggested that just a couple of stocks are plenty. While pouring all your money into a single stock is foolish, over-diversifying can be foolish and limiting too. Next myth: stocks only do well in strong economies. It's not necessary to be able to predict the economy to invest in the stock market successfully. Many studies have shown that there is very little correlation between economic growth and stock market performance. Avoid letting a bad economy dissuade you from being in the market. Yes, the S&P tends to go down before we're in a recession as people spend less money. However, it will tend to trend upwards as we're leaving a recession. The reality is that a recession doesn't last that long if you're investing for the long term. Next myth: bonds are less volatile than stocks. This is actually true over the short term. It's not uncommon for a stock to lose 20% or more in a short period of time. Over long periods of time, though, bonds return are actually more volatile than stock returns. When comparing 10-year Treasury and the S&P 500, it's not even close. The standard deviation for Treasuries has been 2.52% versus 1.58% for the S&P 500. These are 30-year rolling averages since 1928. Over long periods of time, stocks' returns are significantly less volatile than bonds. If your investment horizon is long term, focus on the stocks. And the biggest myth, I think, of all: good companies always have good stocks. No. Microsoft is an excellent example of this myth. The stock fell 37% between 2000 and 2013. The company definitely has had its share of mistakes, but revenues increased over threefold and earnings increased at 2.5 times the rate of the S&P 500. Microsoft has done well, but the stock has performed abysmally. Microsoft was simply overvalued in 2000. Studies have shown that the most heavily favored stocks underperform the most disliked stocks. Eliminating these stock market myths will allow you to make better investing decisions. Wise decisions lead to more profitable returns. How many of these myths did you previously believe? Are there any that you still believe? Do your own research and verify the facts presented. Convince yourself of the truth. Change your belief and watch your returns improve. Thanks for watching and subscribe to the channel for more videos like this.